day 2 of the series, 1.2 financial assets. It is common to distinguish among three broad types of financial assets: fixed income, equity, and derivatives. Fixed income or debt securities promise either a fixed stream of income or a stream of income determined by a specified formula. For example, a corporate bond typically would promise that the bondholder would receive a fixed amount of interest each year. Other so called floating rate bonds promise payments that depend on current interest rates. For example, a bond may pay an interest rate that is fixed at 2 percentage points above the rate paid on the US Treasury bills. Unless the borrower is declared bankrupt, the payments on these securities are either fixed or determined by formula. For this reason, the investment performance of debt securities typically is least closely tied to the financial condition of the issuer. Nevertheless, the fixed income securities come in a tremendous variety of maturities and payment provisions. At one extreme, the money market refers to debt securities that are short term, highly marketable, and generally of very low risk. For example, the treasury bills or bank certificate of deposits, CDs. In contrast, the fixed income capital market includes long term securities such as treasury bonds as well as bonds uh, issued by federal agencies, state and local municipalities, and corporations. These bonds range from uh, very safe in terms of default risk, example treasury securities, to relatively risky, example high yield or junk bonds. They're also designed with extremely diverse provisions regarding payments provided to the investor and protection against bankruptcy of the issuer. We will take a first look at these securities in Chapter 2 and undertake a more detailed analysis of the debt market in Part 4. Unlike debt securities, common stock or equity in a firm represents an ownership share in the corporation. Equity holders are not promised any particular payment. They receive any dividends the firm may pay and have prorated ownership in the real assets of the firm. If the firm is successful, the value of equity will increase. If not, it will decrease. The performance of equity investments, therefore, is tied directly to the success of the firm and its real assets. For this reason, equity investments tend to be riskier than investments in debt securities. Equity markets and equity valuation are the topics of Part 5. Finally, derivative securities such as options and future contracts provide payoffs that are determined by by the prices of other assets such as bond or stock prices. For example, a call option on a share of Intel stock might turn out to be worthless if Intel's share price remains below a threshold or exercise price, such as $30 a share. But it can be quite valuable if the stock price rises above that level. Derivative securities are so named because their values derive from the prices of other assets. For example, the value of a call option will depend on the price of Intel stock. Other important derivative securities are futures and swap contracts. We will treat these in part 6. Derivatives have become an integral part of the investment environment. One use of derivatives, perhaps the primary use, is to hedge or transfer them to other parties. This is done successfully every day, and the use of these securities for risk management is so commonplace that the multi-trillion-dollar market in derivative assets is routinely taken for granted. Derivatives can also be used to take highly speculative positions, however. Every so often, one of these positions blows up, resulting in well publicized losses of hundreds of millions of dollars. While these losses attract considerable attention, they are in fact the exception to the more common use of such securities as risk management tools. Derivatives will continue to play an important role in portfolio construction and the financial system. We will return to this topic later in the text. Investors and corporations regularly encounter other financial markets as well. Firms engaged in international trade regularly transfer money back and forth between dollars and other currencies. In London alone, nearly $2 trillion of currency is traded each day. Investors also might invest directly in some real assets. For example, dozens of commodities are traded on exchanges such as the New York Mercantile Exchange or the Chicago Board of Trade. You can buy or sell corn, wheat, natural gas, gold, silver, and so on. Commodity and derivative markets allow firms to adjust their exposure to various business risks. For example, a construction firm may lock in the price of copper by buying copper future contracts, thus eliminating the risk of a sudden jump in the price of its raw materials. Wherever there is uncertainty, investors may be interested in trading either to speculate or to lay off their risks, and a market may arise to meet that demand. Yeah, and then in the subnotes, it's yeah. A call option is the right to buy a share of stock at a given exercise price on or before the option's expiration date. If the market price of Intel remains below $30 a share, the right to buy it for $30 will turn out to be valueless if the share price rises above $30 before the option expires. However, the option can be exercised to obtain the share for only $30. So that was 1.2 financial uh, assets. So we talked about stocks, we talked about debt securities and bonds, and we talked about the derivatives that can be used based on the prices of those said stocks and bonds. Now we're going to 1.3 financial markets and the economy. We stated earlier that real assets determine the wealth of an economy, while financial assets merely represent the claims on real assets. Nevertheless, financial assets and the markets in which they trade play several crucial roles in developed economies. Financial assets allow us to make the most of the economy's real assets. The informational role of financial markets. Stock prices reflect investors' collective assessment of a firm's current performance and future prospects. When the market is more optimistic about the firm, its share price will rise. That higher price makes it easier for the firm to raise capital and therefore encourages investment. In this manner, stock prices play a major role in the allocation of capital in market economies, directing capital to the firms and applications with the greatest perceived potential. Do capital markets actually channel resources to the most efficient use? At times, they appear to fail miserably. Companies or whole industries can be hot for a period of time. Think about the dot-com bubble that peaked in 2000. Attract a large flow of investor capital and then fail only after a few years. The process seems highly wasteful. But we need to be careful about our standard of efficiency. No one knows with certainty which ventures will succeed and which will fail. It is therefore unreasonable to expect that markets will never make mistakes. The stock market encourages allocation of capital to those firms that appear at the time to have the best prospects. Many smart, well trained, and well paid professionals analyze the prospects of firms whose shares trade on the stock market. Stock prices reflect their collective judgment. You may well be skeptical about resource allocation through markets, but if you are, then take a moment to think about the alternatives. Would a central planner make fewer mistakes? Would you prefer that Congress makes these decisions? To paraphrase Winston Churchill's comment about democracy, markets may be the worst way to allocate capital, except for all the others that have been tried. So basically, what it's saying is that just like how democracy is considered to be like the least evil or the least worst way of governing, countries and people, just like that, markets determining, stock prices and which firms succeed and everything is the best available option that we have compared to all the other alternatives that have been tried and failed miserably. So yeah, now we move on to consumption timing. Some individuals are earning more than they currently wish to spend. Others, for example retirees, spend more than they currently earn. How can you shift your purchasing power from high earnings to low earnings period of life? One way is to store your wealth in financial assets. In high earning periods, you can invest your savings in financial assets such as stocks and bonds. In low earning period, you can sell these assets to provide funds for your consumption needs. By doing so, You can shift your consumption over the course of your lifetime, thereby allocating your consumption to periods that provide the greatest satisfaction. Thus, financial markets allow individuals to separate decisions concerning current consumption from constraints that otherwise would be imposed by current earnings. Allocation of risk. Virtually all real assets involve some risk. When Toyota builds its auto plants, for example, it cannot know for sure what cash flows those plants will generate. Financial markets and diverse financial instruments traded in those markets allow investors with the greatest taste for risk to bear that risk, while other less risk tolerant individuals can, to a greater extent, stay on the sidelines. For example, if Toyota raises the funds to build its auto plant by selling both stocks and bonds to the public, the more optimistic or risk tolerant investors can buy shares of its stock, while the more conservative ones can buy its bonds. Because the bonds promise to provide a fixed payment, the stockholders bear most of the business risk but reap potentially higher rewards. So that's like the trade off that they're talking about. Thus, capital markets allow the risk that is inherent to all investments to be borne by the investors most willing to bear that risk. So basically, what they're talking about here is there are two types of people who invest or want get involved in the financial markets. So one is the more risk tolerant person who's willing to take more risk in wanting further like more rewards, like more risk, more rewards. And the person who doesn't want to take more risk, he can just buy the bonds and have a guaranteed fixed payment coming on his way. So that's the idea they're talking about. This allocation of risk also benefits the firms that need to raise capital to finance their investments. When investors are able to select security types with the risk return characteristics that best suit their preferences, each security can be sold for the best possible price. This facilitates the process of building the economy's stock of real assets. So, yeah, so basically they're saying that if each possible person who has their own needs, like their own level of risk tolerance, some might have a high level of risk tolerance, some might have a very low level of risk tolerance. But if we have a system, which we do, where both of those type of people and everybody in between can buy what they want, buy each security to their level of risk tolerance at the best price, then it basically it facilitates the process of building the economy stock of real assets. That's the system is built in that way basically. Now we talk about separation of ownership and management. So this is very important. Many businesses are owned and managed by the same individual. This simple organization is well suited to small businesses and in fact was the most common form of business organization before the industrial revolution. Today, however, with global markets and large scale production, the size and capital requirements of firms have been skyrocketed. For example, at the end of 2015, General Electric listed on its balance sheet about $57 billion of property, plant, and equipment, and total assets of $493 billion. Corporations of such size simply cannot exist as owner operated firms. Actually has more than 500,000 stockholders with an ownership stake in the firm proportional to their holding of shares. Such a large group of individuals obviously cannot actively participate in the day to day management of the firm. Instead, they elect a board of directors that in turn hires and supervises the management of the firm. This structure means that the owners and managers of the firm are different parties. This gives the firm stability that the owner managed firm cannot achieve. For example, if some stockholders decide they no longer wish to hold shares in the firm, they can sell their shares to other investors with no impact on the management of the firm. Thus, financial assets and the ability to buy and sell those assets in the financial markets allow for easy separation of ownership and management. How can all of the disparate owners of the firm, ranging from large pension funds holding hundreds of thousands of shares to small investors who may hold only a single share, agree on the objectives of the firm? Again, financial markets provide some guidance. All may agree that the firm's management should pursue strategies that enhance the value of their shares. Such policies will make all shareholders wealthier and allow them to better pursue their personal goals, whatever those goals might be. Do managers really attempt to maximize firm value? It is easy to see how they might be tempted to engage in activities not in the best interest of shareholders. For example, they might engage in empire building or avoid risky projects to protect their own jobs or overconsume luxuries such as corporate jets, reasoning that the cost of such um, I don't know this word, perquisites or something, cost of such luxuries is largely borne by the shareholders. These potential conflicts of interests are called agency problems because managers who are hired as agents of shareholders may pursue their own internal interests instead. Several mechanisms have evolved to mitigate policy agency problems. First, compensation plans tie the income of managers to the success of the firm. A major part of the total compensation of top executives is often in the form of shares or stock options, which means that the managers will not do well unless the stock price increases, benefiting shareholders. Of course, we've learned that overuse of options can create its own agency problem. Options can create an incentive for managers to manipulate information to prop up a stock price, temporarily giving them a chance to cash out before the price returns to a level reflective of the firm's true prospects. More on this shortly. Second, while board of directors have sometimes been portrayed as defenders of the top management, they can, and in recent years increasingly have, forced out management teams that are underperforming. Third, outsiders such as security analysts and large institutional investors such as mutual funds or pension funds monitor the firm closely and make the life of poor performers at the least uncomfortable. Such large investors today hold about half of the stock in publicly listed firms in the US. Finally, bad performers are subject to the threat of takeover. If the board of directors is lax in monitoring management, unhappy shareholders, in principle, can elect a different board. They can do this by launching a proxy contest in which they seek to obtain enough proxies, right to vote the shares of other shareholders, to take control of the firm and vote in another board. Historically, this threat was usually minimal. Shareholders who attempted such a fight have to use their own funds, while management can defend itself using corporate coffers. However, in the recent years, the odds of a successful proxy contest have increased, along with the risk of so called activist investors. These are large and deep pocketed investors, often hedge funds, that identify firms they believe to be mismanaged in some respect. They buy large portions in shares of those firms and then campaign for slots on the board of directors and or for specific reforms. One estimate is that since the end of 2009, about 15% of the firms in the S&P 500 have faced an activist campaign and that activists have taken share positions in about half of the firms included in the S&P 500. In 2014, nearly three quarters of proxy votes were won by dissidents, not descendants. Aside from proxy contests, the real takeover threat is from other firms. If one firm observes another underperforming firm, it can acquire the underperforming business, and replace management with its own team. The stock price should rise to reflect the prospects of improved performance, which provides an incentive for firms to engage in such a takeover activity in the first place, basically. So what we talked about there was basically, there are like three layers in a corporation. So you have like the management team, right, which is like at the lowest level, and then above the management team you have like the board of directors, and above the board of directors you have all the shareholders. Which in a large corporation like General Electric, as we saw, they can be millions or half a million or however much there were, and the shareholders elect the board of directors, and the board of directors selects the management team. So if the management team is underperforming, the board of directors selects another management team. But if the board of directors is also underperforming and mismanaging and is lax in the management and makes the whole corporation underperform, then uh, the shareholders can have a proxy contest and therefore select a new board of directors, vote for another board. And this has become increasingly possible and likely in the recent years after 2009, as they said. So, yeah, that was separation of ownership and management. Now we have corporate governance and corporate ethics. We've argued that securities markets. Also, there's some example 1.1. So we just read that quickly before we start that. Example 1.1 is activist investors and corporate control. Here are a few of the better known activist investors, along with the sample of their recent initiatives. Carl Icahn, one of the earliest and most combative of activist investors, challenged Apple to increase cash distribution to investors. William Bill Ackman, Pershing Square Capital, took large positions in J.C. Penney, Valiant Pharmaceuticals, and Kraft Foods with a view toward influencing management practice. Nelson Peltz, Trian, sought board seats on DuPont, pushed for it to split up into more highly focused corporations. Dan Loeb, Third Point, tried to get Sony to spin off its entertainment units. Jeff Smith, Starboard Value, pushed for Staples and Office Depot to merge. Ultimately, the firms did attempt to combine, but the merger was blocked by the federal government on antitrust grounds. So that was a few examples of activist investors. So like we read, activist investors are like deeply pocketed individuals, which all of a sudden buy a lot of shares of publicly traded companies and then attempt to sort of take over a few of the board seats and change the management style and the management team in and of itself. And here we just like read a few examples. Some of the famous ones are Bill Ackman and Carl Icahn, as we read. So that's that. Anyways, corporate governance and corporate ethics. We've argued that securities markets can play an important role in facilitating the deployment of capital resources to their most productive uses. But market signals will help to allocate capital efficiently only if the investors are acting on accurate information. We say that markets need to be transparent for investors to make informed decisions. If firms can mislead the public about their prospects, then much can go wrong. Despite the many mechanisms to align incentives of shareholders and managers, the 3 years from 2000 to 2002 were filled with a seemingly unending series of scandals that collectively signaled a crisis in corporate governance and ethics. For example, the telecom firm WorldCom overstated its profits by at least $3.8 billion by improperly classifying expenses as investments. When the true picture emerged, it resulted in the largest bankruptcy in US history, at least until Lehman Brothers smashed that record in 2008. So, I know this because my favorite thing that I've ever done probably was covering the 2008 financial crisis in back in 12th grade when it was my economics project. So yeah, I learned a lot. I watched Inside Job. I watched Margin Call. I watched Big Short. I watched all these movies and documentaries, and read a few papers and stuff. And it was, yeah, that was really fun to go through that. And yeah, Lehman Brothers definitely smashed that record in 2008. I think the bankruptcy was the record that they broke were like, they were like 613 billion dollars bankrupt. So yeah. The next largest US bankruptcy was Enron. So obviously the Enron scandal, which was early 2000s, maybe like 2000, 2001, something like that. And it was like around the same time as like the dot-com bubble. So I think his name was Jeff Skillings, who went to prison for like 14 years because of the fraud, because of the scam. And yeah, so that was that. Which now, so yeah, Enron, which used its now notorious special purpose entities to move debt off its own books and similarly present a misleading picture of its financial status. Unfortunately, these firms had plenty of company. Other firms such as Rite Aid, Health South, Global Crossing, and Q West Communications also manipulated and misstated their accounts to the tune of billions of dollars. And the scandals were hardly limited to the United States. Uh, Parmalat, Italian dairy firm, claimed to have a $4.8 billion bank account that turned out not to exist. These episodes suggest that agency and incentive problems are far from solved. Other scandals of that period include systematically misleading and overly optimistic research reports put out by stock market analysts. Their favorite analysis was traded for the promise of future investment banking business. And analysts were commonly compensated not for their accuracy or insight, but for their role in garnering investment banking business for their firms. Additionally, initial public offerings were allocated to corporate executives as a quid pro quo for personal favors or the promise to direct future business back to the manager of the IPO. What about the auditors who were supposed to be the watchdogs of the firm? Here too, incentives were skewed. Recent changes in business practice had made the consulting businesses of these firms more lucrative than the auditing function. For example, Enron's now defunct auditor, Arthur Anderson, um, earned more money consulting for Enron than by auditing it, given Arthur Anderson's incentive to protect its consulting profits. We should not be surprised that it and other auditors were overly lenient in their auditing work. In 2002, in response to the spate of ethics scandals, Congress passed the Sarbanes-Oxley Act to tighten the rules of corporate governance. For example, the act requires corporations to have more independent directors. That is, more directors who are not themselves managers or affiliated with managers. The act also requires each CEO to personally vouch for the corporation's accounting statements, provide for an oversight board to oversee the auditing of public companies, and prohibits auditors from providing various other services to clients. So there we just read about the ethics and how the people who are actually supposed to be the regulators, the auditors, who are supposed to make sure that the financial statements that these firms are releasing, are accurate and are not falsified. And we read how they also can and were manipulated and provided incentives not to expose the scandal for their own benefit, which got exposed in the end eventually, anyways. So yeah, now we just go to 1.4 for today. Actually, we'll do 1.4, 1.5. Why not? Then we'll start with the players 1.6 in the next tomorrow's video. So yeah, 1.4 is the investment process. An investor's portfolio is simply his collection of investment assets. Once the portfolio is established, it is updated or rebalanced by selling existing securities and using the proceeds to buy new securities. By investing additional funds to increase the overall size of the portfolio, or by selling securities to decrease the size of the portfolio. Investment assets can be categorized into broad asset classes such as stocks, bonds, real estate, commodities, and so on. Investors make two types of decisions in constructing their portfolios. The asset allocation decision is a choice among these broad asset classes, while the security selection decision is a choice of which particular securities to hold within each asset class. Top-down portfolio construction starts with the asset allocation. For example, an individual who currently holds all of his money in a bank account would first decide what proportion of the overall portfolio ought to be moved into stocks, bonds, and so on. In this way, the broad features of the portfolio are established. For example, while the average annual return on the common stock of large firms since 1926 has been better than 11% a year, the average return on US Treasury bills has been less than 4%. On the other hand, stocks are far riskier with annual returns as measured by the Standard & Poor's 500 index, S&P 500 index, that have ranged as low as minus 46% and as high as 56%. In contrast, T-bills are effectively risk-free. You know what interest rate you will earn when you buy them. Therefore, the decision to allocate your investments into the stock market or into the money market where treasury bills are traded will have great ramifications for both the risk and return of your portfolio. A top down investor first makes this and other crucial asset allocation decisions before turning to the decision of the particular securities to be held in each asset class. Security analysis involves evaluation of the particular securities that might be included in the portfolio. For example, an investor might ask whether uh, Merck or Pfizer is more attractively priced. Both bonds and stocks must be evaluated for the investment attractiveness, but valuation is far more difficult for stocks because a stock's performance usually is far more sensitive to the condition of the issuing firm. In contrast to top down portfolio management is the bottom up strategy. In this process, the portfolio is constructed from securities that seem attractively priced without as much concern for the resultant asset allocation. Such a technique can result in unintended bets on one or another sector of the economy. For example, it might turn out that the portfolio ends up with a very heavy representation of firms in one industry from one part of the country or with exposure to one source of uncertainty. However, a bottom up strategy does focus the portfolio on the assets that seem to offer the most attractive investment opportunities. So yeah, there we talked about the investment process. So basically, an investor before deciding what stocks or what bonds to buy, he'll first decide the percentage he will allocate to each asset class. That depends on how risk tolerant he is. If he's high risk tolerant, then we can safely assume that he will have a higher percentage of stocks in his portfolio than bonds, and vice versa. So that was what we talked about in 1.4, the investment process. Now we move on to 1.5, the last thing we'll do for today. Markets are competitive. Financial markets are highly competitive. Thousands of intelligent, and well-backed analysts constantly scour security markets searching for the best buys. This competition means that we should expect to find few, if any, free lunches. And free lunches are also called arbitrages. I think that's what I think. Yeah. Securities that are so underpriced that they represent obvious bargains. This no free lunch proposition has several implications. Let's examine two. The risk return trade off. Investors invest for anticipated future returns, but those returns rarely can be predicted precisely. There will almost always be risk associated with investments. Actual or realized returns will almost always deviate from the expected return anticipated at the start of the investment period. For example, in 1931, the worst calendar year for the market since 1926, the S&P 500 index fell by 46%. In 1933, the best year, the index gained 55%. You can be sure that the investors did not anticipate such extreme performance at the start of either of these years. Naturally, if all else could be held equal, investors would prefer investments with the highest expected return. Excuse me. However, the no free lunch rule tells us that all else cannot be held equal. If you want the higher expected returns, you will have to pay a price in terms of accepting higher investment risk. If a higher expected return can be achieved without bearing extra risk, there will be a rush to buy the higher return assets, with the result that their prices will be driven up. Individuals considering investing in an asset at the now higher price will find the investment less attractive. Its price will continue to rise until expected return is no more commensurate with risk. At this point, investors can anticipate a fair return relative to the asset's risk, but no more. Similarly, if returns were independent of risk, there would be a rush to sell high risk assets and their prices would fall. The assets would get cheaper, improving their expected future rates of return until they eventually were attractive enough to be included again in investor portfolios. We can conclude that there should be a risk return trade off in the securities markets, with the higher risk assets priced to offer higher expected returns than lower risk assets. Of course, this discussion leaves several important questions unanswered. How should one measure the risk of an asset? What should be the qualitative trade off between risk properly measured and expected return? One would think that risk would have something to do with the volatility of the asset's returns, but this guess turns out to turns out to be only partly correct. When we mix assets into diversified portfolios, we need to consider the interplay among assets and the effect of diversification on the risk of entire portfolio. Diversification means that many assets are held in the portfolio so that the exposure to any particular asset is limited. The effect of diversification on portfolio risk, the implication for the proper management of risk, and the risk return relationship are topics of part 2. These topics are subject of what has come to be known as modern portfolio theory. The development of this theory brought two of its pioneers, Harry Markowitz and William Sharpe, Nobel Prizes. Efficient markets. That's the last topic. Efficient markets. So these are like the two implications of the no free lunch proposition. So the risk return trade off is one, which basically is saying that if something sounds too good to be true, it is too good to be true. Like that's what we're talking about essentially. That there's no free lunches. That everything in the market, every share, every sort of potential buy has been analyzed by like a dozen people, who are probably way more smarter than you. And if it's still looking like you can make like a lot of money from it, and it doesn't seem like it has like a lot of risk, then it's probably like a scam, and it's probably not, something's off with it basically. So there's always a risk return trade-off, and you will never get something that is potentially a higher return without the implicated risk associated with it. So anyways, yeah, that's what we were talking about there. Now we're talking about the efficient markets. Another implication of the no free lunch proposition is that we should rarely expect to find bargains in the security markets. We will spend all of chapter 11 examining the theory and evidence concerning the hypothesis that financial markets process all available information about securities quickly and efficiently. That is, the security price usually reflects all the information available to investors concerning its value. According to this hypothesis, as new information about a security becomes available, its price quickly adjusts so that at any time the security price equals the market consensus, an estimate of the value of the security. If this was so, there would be neither underpriced nor overpriced security. One interesting implication of this, the efficient market hypothesis, concerns the choice between active and passive investment management strategies. Passive management calls for holding highly diversified portfolios without spending effort or other resources attempting to improve investment performance through security analysis. Active management is the attempt to improve performance either by identifying mispriced securities or by timing the performance of broad asset classes. For example, increasing one's commitment to stocks when one is bullish on the stock market. If markets are efficient and prices reflect all relevant information, perhaps it is better to follow passive strategies instead of spending resources in a futile attempt to outguess your competitors in the financial markets. If the efficient market hypothesis were taken to the extreme, there would be no point in active security analysis. Only fools would commit resources to actively analyzing securities. Without ongoing security analysis, however, prices eventually would depart from correct values, creating new incentives for experts to move in. Therefore, even in environments as competitive as the financial markets, we may observe only near efficiency, and profit opportunities may exist for especially diligent and creative investors. In chapter 12, we examine such challenges to the efficient market hypothesis, and this motivates our discussion of active portfolio management in part 7. More importantly, our discussion of security analysis and portfolio construction generally must account for the likelihood of near efficient markets. So there we are talking about basically the efficient market hypothesis, which basically says that like since like the entire world is like computerized, right, and everything is on internet, and like these days with AI and everything, so what it's saying is that if the market was truly and purely efficient, and all the computer systems all over the world, and all the different institutional investors and companies and everything, if they analyzed all the information that is present in the entire world regarding security markets, then we wouldn't have anything to do about it. Like they would have all the information, they would have all the algorithms available to them, so they would just like find the right price for each security, and there would be nothing else for active investors to do. But that is not true, since the market is not purely efficient, it's near efficient, so it's really hard to be a successful investor. But it is possible if one is creative and a diligent investor, like they said. So that is why I am doing this. That is why anybody who is interested in stocks and financial markets is doing this. And many people do CFA and everything, and many people just start day trading to just learn from on hand experience, and that's also commendable, although that's like a little bit risky and more towards gambling sometimes if you don't know what you're doing. But that's the whole point. That's why we do active investing. Like I also do passive investing. Like I have money that my father manages, and like that is passive investing for me, because I have nothing to do with where that money goes and how it grows. But why anybody would do active investing is because they believe, and everybody believes, that they can actually find a stock where it is undervalued, and it's an incentive to buy and profit from it, and they do profit from it. So that's why anybody even bothers to do this. Because if the market was truly efficient, and if the efficient market hypothesis was real, then only fools would try to be active investors. So anyways, that is the last part of today's video, and I'm very glad that I could you know that I've been able to stay consistent with it for the second day. It's only the second day, but I'm happy that there's a day two. So yeah, we just end it like that, and I have a stats midterm day after, so I'm gonna pull an all-nighter and prepare for that. So yeah, thank you for watching. If anybody ever watches this.